So let's get started talking about divergence. Now, before we do, I want to mention if you look on your screen, you can see a little section that says handouts. And there's the ETX Capital Technical Indicators guide there I put up there for you. That's a guide we've put together just for you, and we'll give it to you in the live class. So if you can click on that download button and download it to whatever device you're using, you can move it around to look at it later. But it's a helpful little guide on all the major technical indicators available in the marketplace. Also tonight, I'm going to be sharing with you two presentations that are prepared presentations. If you'd like to see these, again, you can go to the ETX Capital YouTube site. So just go to YouTube and look up ETX Capital, and you can find them in the playlist right there. So let's get on talking about divergence. In the Forex markets, and for that matter, even future stocks, cryptocurrency, in any liquid market, divergence is often related to the price and the oscillator that is tracking that price. Now, divergence is not an indicator. Divergence isn't even a signal. Okay, it appears in all oscillators, especially bounded oscillators. Oscillators are the trading indicators that we put on the bottom part of our screen. And divergence is an event that happens when the relationship between the oscillator and the price diverges. So it doesn't matter what oscillator or indicator you're using. Let me pop up a live chart and let me show you this right on the chart. So for instance, we're now looking at the current chart for Boeing. Okay, so down on the bottom half of the chart, we have our indicator and we have price action. Now, before we talk about exactly what divergence is, it is the relationship between the movement of the oscillator. And you notice here, the oscillator is making lower highs. So the oscillator is moving in what could be called a downtrend action, while price action is actually moving in an uptrend. So what happens is divergence is simply the fact that the two instances, the price action, the two instruments we're looking at, and the indicator are diverging from each other. Now we have 6 different types of divergence, but they all basically tell us the same thing. Here, this is the British pound Swiss franc. Here we see divergence also, where we see price has been moving upward, and the indicator, RSI, was moving downward. Okay. What divergence is telling us, and we'll talk about what it's telling you in a sec. Okay. But when you see divergence, it is an alert. Divergence does not give you signals. It doesn't tell you to make a trade. It's saying that there's something out of whack between the price indicator, the price action, and the indicator, which is telling you that something isn't right in the market. In most cases, it's telling you the current trend is about to end. But divergence alone doesn't tell you. It's just an alert. It's something hitting you on the back of the head that's saying, look at me. So an oscillator is used to track overbought and oversold prices. So like we have oscillators, stochastics, MACD, RSI. Okay. Now, these are oscillators because they oscillate up and down in a range below, and they're put on the chart below. We have bounded oscillators. Bounded oscillators always will come within a price. So if you know RSI or stochastics, they use the 70 and 30 range as overbought and oversold, and they're bounded no matter no matter what the market does, the calculation for those indicators will always come out between 0 and 100. So they're bounded in those numbers. You have other oscillators that are non-bounded, that come out whatever they come out, but they're oscillating up and down as price moves. So because most of the oscillators are based on price and the relative momentum or volume, oscillators are the best choice for understanding momentum in price, which signals how strong the prevailing trend is. When price reverses or retraces, the oscillator tends to follow the same pattern. Therefore, when prices are making higher highs or higher lows, the oscillator tends to mimic the same overall pattern. Now, it's not identical because it's not price, but it tends to move up as price is moving down and move down as price is moving down. So when price makes a high or a low and the oscillator fails to confirm the same, it is known as divergence. So divergence is simply what the word means. Two things are diverging. Now, by spotting these divergences, traders are usually signaled to a potential change in the direction of price. Now, as traders, one of the most important things we can do is be aware or be prepared ahead of time for when a trend is about to end or a shift in price is about to take place. So divergence is, like I said, is that alert. Is hitting you on the back of the head and saying, hey, trader, we might have a shift in market direction. It's a potential change. Now, divergences are formed when there's a mismatch between price action and momentum, measured by the oscillator relative to price. Because you got to remember, in fact, I don't know any oscillator that doesn't use some combination of the open, the high, the low, and the close. Now, it may be things that add on standard deviation, or it may have a derivative of a derivative of a derivative, or it may use some moving average, but they all come back to being based on either a combination of the open, the high, the low, and the close, or just the close. But since their base mathematical calculation is based on one of those prices on price action, therefore their movement should have some relationship. So therefore, divergence trading can be used not only to time the entry into a trade within a trend, but it can also help to understand support and resistance levels. While divergences are broadly classified into four types, the underlying theme among the four types of divergence is that it shows price exhaustion when the oscillator fails to confirm new highs or lows. Divergence takes place in all time frames. So you can spot divergence in a 15-minute chart, or you can spot divergence in a one-day chart. However, the best results come when divergence is spotted on higher time frames, such as 4-hour sessions or higher. So like we saw on the chart here for Boeing, I just want to pop that chart back up on our screen. Okay, this is a beautiful divergence pattern. Now, we're looking at a 4-day chart. So this is a long period. But it is a very, very good indication that something is happening in the marketplace. And look at this. When we had this ultimate divergence of the second divergence, we had the lower one here and then the second one. Look at what happened at that divergence. Price did diverge. Price took a major plummet. Now, the thing is, we don't know where that divergence is going to end. It simply was telling us that this trend, this short trend, was in danger. Okay, was potentially about to get a market shift. And we got a very, very strong market shift. Okay, so up here, let me get my markers off of here. Up here, we even got an engulfing candle, which told us that this trend was ending. So we had confirmation in two different ways. But look at this, our RSI was not down, was not in the overbought or the oversold position at this point. But at this point on this divergence, it had broken above the 70. Sorry, I'm having a problem getting my markers off and on here. Okay, right at this point, it had also broken above the 70, which had told us the market was overbought, which coincided with this point right here. Okay, so we had our divergence. We had our RSI break into that overbought zone, and we had a bearish engulfing candle. So we had everything right here to tell us the market was about to shift. But that's shifting in a 4-hour time segment. Okay. You have to look at shorter time segments to make any headway out of what's going on. And divergence is not a standalone tool. Again, here we can see the divergence with the RSI as the Swiss franc was moving up. And we can see what happened here. As it broke above the trend line here and hit the Fibonacci reversal zone, it turned around and collapsed. Okay. Now, in this case, RSI did not break above the overbought level. It barely touched it. The highest we got it to was right here. It was at 69.21. So it never broke into that 70 level. So you can't just use the divergence, but you can't ignore or wait for the RSI necessary to break above. So divergence is just one clue. Now, again, divergence doesn't work well alone. Okay. It just gives you some information. So one of the most common mistakes often made with divergence trading is that traders expect the price to behave in a certain way when the divergence is spotted. This is wrong. Just because a divergence is formed doesn't mean the price will reverse. In the chart shown that we were looking at, you will find a new divergence setup where price moved in the opposite direction, contrary to what divergence was telling you. It is therefore important to understand that traders should look for other confirmation tools before trading divergence setups. Now, divergence breaks down into 4 categories. They're what we call regular and classic divergence, and we have on each side of that we have bullish divergence and bearish divergence. They're just the opposite of each other. Period. The end. And everything in the markets, there are mirror reflections if you're coming off of a downtrend or moving to an uptrend. And then we have hidden divergence. So we have regular bullish divergence and regular bearish divergence. And then we have hidden bullish divergence and hidden bearish divergence. It's kind of hard to see the difference. I just see divergence. Okay, I have a very difficult time spotting exactly what we consider hidden divergence. So here in this chart, we try to give you an example of what they are. So here you have price for regular bearish divergence. You have price moving upward while the oscillator is moving downward. So that's regular bearish divergence. Okay. Regular bullish divergence, the oscillator is moving upward while price is moving downward. Hidden divergence is also the same. Price is moving down and the oscillator is moving up. Okay, what's the difference? Flip them over. Okay, here we were using underneath, here we're using above. To me, it's all just divergence. When the price diverges from the asset. Okay, so what it is the waves we're using. So here, if you're using wave 2 to wave 4, or you're using wave 1 to wave 3. Okay, that's the only difference. I don't trade waves. And so I just look for the overall opposite movement in opposite direction. Okay. So here we've broken it down. When price is making higher, going from a high to a higher high, but the oscillator is going from a high to a lower high, that's regular bearish divergence. When the price is going from a low to form a new lower low, but the oscillator is going from a low and forming a higher low, that's regular divergence. Now, when price is moving from a high to a lower high, which is really slightly a downtrend, and the oscillator is moving from a high to a higher high, that is hidden bearish divergence. And the opposite is hidden bullish divergence when we're moving from a low to a higher low, and the oscillator is moving from a low to a lower low. So the difference is a very finite definition of where they're appearing, but we have bearish divergence here and bearish divergence here. Here we move from high to lower high, and the oscillator is moving from high to higher high, where here we're moving from high to higher high, high to lower high. It's a lot of words, but it all looks the same in reality. So a regular divergence is used as a possible sign of a trend pause or a trend reversal. A regular bullish divergence occurs when the price is making lower lows, but the oscillator is making higher lows. Usually this happens at the end of a downtrend. Price and momentum are expected to move in line with each other. If price makes a new low, but the oscillator fails to make such a new low itself, it is usually likely that the price will retrace and even reverse. Okay, so we've said a lot of words. I've tried to show it to you on the charts, but I have a presentation which will combine divergence and RSI, which I'll try to show you in a much better graphic formation. So let me pop that up and share that with you. And then we'll come back and look at how to put these indicators on the ETX Pro platform. So as you can see, divergence can be used in multiple manners. When the currency is diverging, the likelihood of a trend continuation is decreasing and the trend reversal is possible. When a currency is converging, the likelihood of a trend continuation is high and trend reversal is unlikely. When the currency is doubled or triple divergence, the likelihood of trend continuation is unlikely and a trend reversal is a decent probability. So double or triple divergence is what we showed you in Boeing. And those Boeing charts and the pound charts are current charts. So you see it does occur quite often in the marketplace. Now the oscillators indicate to us that momentum is possibly shifting, and even though the price has made a new peak or bottom, the chances of the momentum being sustained and continued are decreasing. Regular divergence is useful for cautiously predicting the end of a trend. Cautiously. But only in some cases will the currency pair totally reverse for a trend in the opposite direction. May I emphasize the word cautious in the previous sentence. It is tricky trading element to master, and is always beneficial to add to other methods of confirming a trend in spotting potential trend ending. So what we're looking here is a divergence pattern. The name of the pattern speaks of its character. We have a divergence when the price movement is contrary to the indicator. That's it. So we have bullish and bearish divergence. Okay. Here you can see a whole setup on these charts of divergences. Okay. You can see the explanation for hidden divergence here, and remember, when you're drawing divergence on your oscillator, it's not a trend line. It doesn't follow the rules that it can't be broken through. It is simply that the overall trend, or the line you can draw on there, is making lower lows as the price makes higher lows. So here we see a full array of bullish and bearish divergence again on this chart. So spotting divergence takes time. It does not we don't expect results overnight. The best way to get started with spotting divergence is to use one of the many custom divergence indicators. These automated indicators spot the divergence for you when you can, and tells you when to act. Okay. In terms of which oscillator to use, the RSI makes for an ideal oscillator to train your eye to spot the divergence. But today, there are so many scanners and available things in the marketplace and apps you can download that you just tell it when divergence comes, and you tell it what price frame, what asset, it's going to notify you. So you don't have to go searching for it. But I always think it's best to do it yourself, because whatever assets, and that's why I only trade a limited range of assets, because I want to be watching my charts all the time when I'm trading. Okay? And I want to spot my own divergence. Now, there is no divergence or bad divergence. Okay. When you have divergence, you have divergence. Okay, it's just plain and simple. Here we're using the MACD histogram to spot divergence. So one method of analyzing divergence from a different perspective is by using trend lines and trend channels. Once divergence occurs in the market, the signal line trend line can identify when the trend is ending and may signal the end of a trend. Waiting for the break could be one way of trading divergence. Similar trend lines can also be used on the momentum indicators themselves. So you can, hypothetically, set up two trend lines on your chart and look for divergence. And today, a lot of charts, and I'm going to pop you up on the ETX Trader Pro charts, and we're going to show you how to put the indicators on there. But you can put up, say, channel trend lines, and when you can put a trend over top of price and one under price, and when they're diverging, you can use those as an indicator. So another important point is by managing expectations about a divergence, there is a substantial difference between the pip size of a reversal and a retracement. So be careful to reckon and plan on both in your trading. One way of distinguishing between the two is to look at different time frames. If a trader is observing a 15-minute or a 1-hour divergence, the divergence will most likely create a pause or retrace within the bigger trend continuation. So one way to verify it is if you're looking at a 15-minute chart or 1-hour chart, pop it back to a 2-hour or 3-hour chart and see if that divergence is holding. If a higher time frame has divergence, the likelihood of a trend reversal is higher. Basically, the higher the time frame, the more powerful, as you can see in the example of the euro, which we're going to pop up on the screen in a minute. A trader can also decrease the risk of divergence trading by only trading divergences when they occur in multiple time frames. The likelihood of a bounce increases when more time frames show diverging momentum between price momentum. So it's simply impossible to trade divergence without having an extra indicator on the chart. So the question becomes which indicator or indicators are best for divergence trading. Also, money management, we have discussed the types of divergence patterns and some reliable indicators to trade divergence with. Now we need to spot divergence and how to enter the market on a divergence. However, before you start trading divergence setups, there are a few points which we need to discuss further, these things include an example of money management approach, because we don't want to ever trade without using risk management and money management to set up our trusses, our trades, and our likely losses. So regardless of the trading method you use, you should always use a stop loss for each of your trades. It is no different when you trade divergence. And for most traders, it is best to place a hard stop in the market instead of using a mental stop. So as far as divergence setups go, one way to place your stop loss would be to put it right above the last top on the chart, which confirms the bearish divergence. So in other words, let me pop up the charts again. We would use this point to set our stop loss. So if we were trading taking a bearish trade here, a short trade here, when it broke through the divergence, we would use the top of that divergence right here on this. Hold on, let me darken it so you can see it. We would use this point to set our stop loss. This is the only point that RSI was above the 70, the overbought, and also the highest point that it achieved in the bearish. And we would use that to set our stop loss point. So I'm going to pop up a presentation and share with you how we would use these indicators and put them on the charts on the ETX Trader Pro platform. So once you've got your indicator on the chart, we can then start looking for divergence and look for draw the lines right directly on the ETX Trader Pro platform. Divergence is very popular, and you saw in our earlier presentation with RSI. It also works great with MACD. Okay. And here's an example of MACD when we get our crosses. So MACD on the bottom of our chart is a histogram and the MACD and the MACD signal line. Okay, we can look for divergence in the MACD line as price moves up and the MACD line, the red line below, or the histogram starts moving in opposite directions. So here we have the perfect example where MACD or the price action is moving one direction and our MACD line is moving in the opposite. Okay. We get a crossover right here at that point, which gives us an entry point. We would then enter a market. We put our stop loss at the lowest point of that divergence right here. We would probably go long at this point. This is where we get the crossover. And when we got our next cross, that's when we would close out our trade. So it works very well with MACD, but you have to learn to master MACD also. And so we have discussed various types of divergence. The indicators that can be used to trade them, and also trade management techniques that can be employed within a divergence strategy. This should be a good base from which you can create and start testing out a divergence method of your own. Now, as I mentioned, divergence in RSI is very, very popular and used by lots of traders. Divergence works on all indicators, but my favorite by far is RSI. The RSI compares the average gain and the average loss over a certain period. So, for example, if your RSI is set to 14, it compares the bullish candles and the bearish candles over the last 14 candles. When the RSI value is low, it means that there were more and stronger bearish candles than bullish candles over the last 14 candles. And when the RSI is high, it means that there were more and larger bullish candles over the last 14 periods. So when we have more, the market is moving down. Again, quite easy to see. We have a downtrend, and our RSI is in an upward slope. Okay, that's a very good way to explain it. We have divergence. So understand when your indicator is high or low. It's important when it comes to interpreting divergence. And I generally encourage traders to look beyond the squiggly lines of their indicators to explore what it really does. During trends, you can use the RSI that compare the individual trend waves and to get a feeling of the strength of the trend. So typically, the RSI makes higher highs during healthy, strongest bullish trends. This means that there were more and larger bullish candles in the most recent trend wave, and these were compared to the previous wave. When the RSI makes similar highs during an uptrend, it means the momentum of the trend is unchanged. When the RSI, now we're not talking about the candlesticks, we're talking about the RSI indicator. When the RSI makes an equal high, it does not qualify as divergence because it just means that the strength of the uptrend is still up and stable. Higher highs in the RSI do not show a reversal or weakness. It just means that the trend is progressing unchanged. When you see the price is making a higher high during a bullish trend, but your RSI makes a lower high, it means that the most recent bullish candles were not as strong as the previous price action, and the trend is losing momentum. This is what we call a divergence. The divergence signals the end of the uptrend, and it makes a downtrend possible. So So as you can see in the chart, okay, at this point, we're now looking at a possible downtrend. Okay, price has moved all the way to the top. RSI is diverging. Okay, RSI has been over top of the 70, telling it was overbought, and up by 80, is now fallen back in. So we're now expecting a downtrend move. So classic technical analysts tell us that a trend exists when price makes higher highs, but like too often, conventional wisdom is seldom right and usually simplifies things too much. A trader who only relies on highs and lows for his price analysis often misses important clues and does not fully understand the market dynamics. So even though a trend could look healthy at first glance, it might be losing momentum at the same time. When we look deeper at the candles and the momentum, we might see that something is happening. So I'm a pure reversal trader, and early trend trades after divergence are my bread and butter. So a divergence does not always lead to a strong reversal, and oftentimes price just enters a sideways consolidation after a divergence. Keep in mind that a divergence just signals a loss of momentum, does not necessarily signal a shift in trend shift. Okay, so remember though, also a divergence will occur before the indicator necessarily moves into overbought and oversold conditions. So as I told you earlier, it's really just a pat on the back of your head telling you to prepare. So location is a universal concept in trading, regardless of your trading system. Adding the filter of location can usually always enhance the quality of your signals and trades. Instead of taking trades just based on a divergent signal, you'd wait for the price to move into a previous support and resistance zone, and only then look for divergence and trend shifts for times to enter. So to sum it up, a divergence setup is a leading pattern giving us an early entry into emerging price moves. Divergence trading is an effective method and allows traders to combine price action and indicator analysis into a strategy. There are 4 types of divergence: bullish and bearish regular, and then hidden bullish and hidden bearish divergence. Some reliable indicators for trading Forex divergence are MACD, RSI, stochastics, and momentum oscillators. A sound money management plan is required for trading divergence, or any strategy for that matter. Divergence signals do not provide clear profit targets. We do not know how far the price is likely to go once it reverses. So in many cases, we have to utilize other techniques to exit our divergence trade setups. The MACD is a good standalone tool for trading divergence. When you trade divergence with MACD, it can be used to provide you with entry and exit signals as well as overbought and oversold conditions. It's important to remember that most trading approaches relying upon divergence are based on correlations between the momentum oscillator and the security's price action. In the event that a security is in the midst of a strong trend, momentum oscillators can provide false counter-trend signals. Conversely, when a market enters a consolidation phase, the lack of sufficient price action may lead to a scarcity of clear-cut signals. So being aware of the current market state is imperative to a trader incorporating divergence into his or her approach. Ultimately, divergence is best utilized as a tool for confirmation and should be used to make trading decisions in concert with other aspects of technical and fundamental analysis. So thank you very much for joining us tonight. Okay, and remember, divergence is simply a concept applied with all oscillators and indicators. It just gives you a little bit of a forewarning that something's happening in the marketplace. So thank you very much for joining us. Have a great trading week, and we'll talk to you again real soon.